Hello everyone, welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of Chapter 11 from the book How to Swing Trade by Brian Pezim. It has been created with the help of AI. The chapter is titled Swing Trading Rules. You can read the original post at samfury.com.
All right, welcome back everybody for another deep dive. This time around, we're looking at swing trading and more specifically, how to manage risk from Brian Pezim's book, How to Swing Trade. And one of the things that stood out to me was something that might seem super obvious at first.
Yeah.
Holding stocks overnight.
Right.
But Pezim really gets into the weeds about why that's actually a huge risk for swing traders. And it's something that a lot of people, especially beginners, probably don't even think about.
No, they don't. And it's a big difference between swing trading and day trading.
Right.
Because day traders, by definition, they close out all their positions every day before the market closes.
Yeah.
So they never have that overnight risk.
Yeah.
But swing traders, they're holding positions for, could be days, could be weeks.
Right.
So that means they're exposed to anything that happens when the market's closed.
Okay, so I get the basic idea, but what's the big deal, really?
Yeah.
What kind of stuff can happen overnight that's going to totally tank my portfolio?
Well, think about it. What if you're holding a stock, everything seems good, and then bam, the company releases a terrible earnings report, or there's some big product recall, or a scandal breaks, who knows?
Right.
And the stock price just plummets.
Right.
Now you're stuck because you can't do anything until the market opens again. And you might be forced to sell at a huge loss.
Ouch. Yeah. So it's like you go to sleep, everything's fine, and you wake up and your portfolio's on fire.
Exactly. It's like sleeping through an earthquake, You wake up and it's like, whoa, what just happened?
So how do we avoid that? What does Pezim say about how to actually manage this whole overnight risk thing?
Well, he actually gives some pretty good advice in the book. His first rule is super simple, but it's really important. Don't hold through earnings reports or any other big scheduled event, like a product release.
Okay, that makes sense.
You just don't know what's going to happen. It's too unpredictable. Holding through earnings, it's like playing roulette. You might get lucky, but the odds are definitely not in your favor.
Yeah, high risk, high reward, and probably more often high risk, high loss.
Exactly.
Okay, so that's rule number one. Don't hold through big events. What else?
Rule number 2 is all about due diligence. Don't just blindly follow the hype or buy something just because you saw a tip on Twitter.
Right.
Really dig deep into the company's financials. Understand their products. Look at their competition, the whole 9 yards. Because the more you know about a company, the better you can predict how they're going to react to different events, even unexpected ones.
So it sounds like knowledge is power.
Absolutely. It's the best way to protect yourself from those nasty surprises.
Okay, that makes sense.
Yeah.
And I'm guessing there's a rule number 3, right?
Of course. Pezim's rule number 3 is all about sticking to your plan. You need a solid risk-reward plan before you even think about making a trade. And once you've got that plan, stick to it, no matter what, because trading can be really emotional, especially when you're losing money.
Oh, yeah, I can imagine.
And a plan will help you make rational decisions, even when your emotions are going haywire.
Yeah, it makes a lot of sense. So don't let fear and greed cloud your judgment.
Exactly.
Okay, cool. Now, besides this whole overnight holding thing, your notes also mentioned something about a specific type of stock that Pezim says swing traders need to be extra careful with. Something about OTC and penny stocks.
Right.
Can you maybe break those down for our listener? What are they and why are they so risky?
Sure. So OTC stocks, or over-the-counter stocks, they're not listed on the major exchanges. They're not on the NASDAQ. They're not on the New York Stock Exchange. They're created directly between parties, often through networks of dealers. And then penny stocks, well, they're just what they sound like. They're stocks that trade for, really low prices, typically under $5 a share.
Gotcha. So why are these so risky for swing traders?
Well, the main thing is they tend to be less regulated and much more volatile than stocks on the major exchanges. So with OTC stocks, you've got less oversight. It's kind of the Wild West out there.
Yeah.
And with penny stocks, well, they're often driven more by speculation and hype than by actual fundamentals.
This whole penny stock thing, it reminds me of, I was reading this article a while back about this crazy pump and dump scheme.
Oh, yeah.
Where this group of people basically artificially inflated the price of a penny stock, got all these people to buy it, and then they just dumped all their shares. And, of course, the price crashed, and everyone who bought in late lost a ton of money.
Yeah, it happens all the time.
So, it really highlights what we were talking about earlier, right?
Right.
about reliable information.
Yeah.
Got to know what you're getting into.
Absolutely, and you got to be really careful about who you're getting your information from, especially with these more volatile stocks.
So what's the takeaway here? Like, how can our listener protect themselves from getting caught up in one of these shady penny stock deals?
Well, Payzim has a rule for that too. Rule number 4, stick to stocks that are traded on the major exchanges and have a share price of at least $2.
Oh, okay.
Because that $2 threshold, it helps you focus on companies that are more established, They're
Right.
more transparent,
Mm.
and they're less likely to be manipulated.
Like a built-in safety filter.
Exactly. It's not foolproof, but it definitely helps to weed out some of the riskier investments.
Okay, so to recap, we've got 2 big areas of risk that swing traders need to watch out for: holding positions overnight and messing around with OTC and penny stocks.
Right.
And Pazine gives us 4 really solid rules for mitigating those risks.
Yeah.
Number 1, avoid holding through major events.
Right.
Number 2, do your due diligence. Know what you're investing in. Number 3, have a risk-reward plan and stick to it no matter what.
Right.
And number 4, stick to the major exchanges and make sure the stock is trading above $2 a share.
Exactly.
So that wraps up our deep dive on swing trading risk management.
Great stuff.
But before we go, I got to leave you with something to think about. We've been talking about swing trading specifically, but how might these rules apply to other types of investing? Like, what about long-term investing? Or even real estate? Could the ideas behind these rules be adapted to help manage risk in other areas of your financial life? Something to think about. And as always, remember, this is just a starting point. Do your own research, talk to a financial advisor, and make the best decisions for you.
Great advice.
Thanks for joining us for another deep dive, everyone.
See you next time.
We'll catch you on the next one.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.